Hey everyone, and welcome. When you first look at a company's financial numbers, you ever get the feeling you're not seeing the whole picture? Well, today we are pulling back that curtain. We're going to talk about one of the most important processes in accounting, how we turn that messy, incomplete first draft of numbers into a clear, accurate, and final story. And we do it all with something called adjusting entries.
So let me ask you this, and be honest. You're tracking your money in, your money out, but is your business actually as profitable as you think it is at the end of the month? The answer might really surprise you, because without a few key edits, those financial reports you're looking at could be, well, a little misleading.
All right, so here's our game plan. We're going to start with what I call the end-of-month problem. Then we'll look at the solution, which is, you guessed it, adjusting entries. We'll break those down into the two main types, prepayments and unpaids, using a really simple case study. After that, we'll see the final accurate picture and wrap it all up with why this is so critical for any business. So, what is this end-of-month problem? Well, think of your first list of accounts, what accountants call the unadjusted trial balance, like a rough first draft of a story. It's a solid start, for sure, but it's just not finished. Why? Because some of the most important business activities, like, say, using up your office supplies bit by bit, don't create a big, loud transaction every day. They just happen silently in the background. This whole problem really only exists because of something called accrual basis accounting. Now, the simple way, cash basis, is just what it sounds like. Money in, money out. But accrual basis tries to paint a much more realistic picture. It records revenue when you've earned it, not just when you get paid. And it records expenses when you've incurred them, not just when you write the check. And that little difference is exactly why we need to make adjustments. To get accrual accounting right, we live by two golden rules. First, revenue recognition. You can only count the money when you've actually done the work. It's that simple. And second, the matching principle. You've got to line up your expenses with the revenue they helped you earn, all in the same time period. Adjusting entries, they're the tool that makes sure we follow these rules to the letter. Okay, so we've got our problem and we've got our principles. The solution that bridges the gap between them? Adjusting entries. You can think of them as the essential edits that take our rough draft and turn it into a polished, final report that actually reflects reality. So what are they, really? Simply put, they're special journal entries we make right at the end of an accounting period, like a month or a year. Their whole job is to get all the account balances up to date. And the key thing to remember is they always happen before you create the big official financial statements. Now, the great news is we can group pretty much every adjustment into two simple categories. First, you have deferrals or prepayments. This is where cash moved first, but the activity comes later. Think paying for a year of insurance up front. Then you have accruals or unpaids. This is the exact opposite. The activity happened first, but the cash is coming later. Think of hours your employee worked that you haven't paid them for yet. Let's see how this plays out with our case study, Sophia's Consulting Services. All right, let's dive into that first category, deferrals. This is all about accounting for things that were paid for ahead of time but get used up as the days go by. Our first example is a classic, office supplies. So Sophia started the month with $600 worth of supplies sitting on her shelf. In her books, that's an asset. But by the end of the month, she does a quick count and finds there's only $500 worth left. That means $100 of those supplies got used up. They've literally transformed from an asset into an expense. So here's how we record that. We make an adjusting entry. We debit or increase her supplies expense by $100 to show that cost. And at the same time, we credit or decrease her supplies asset account by $100. Boom. The expense is now perfectly matched to the period where the supplies were used. Okay, here's another deferral, but this time from the revenue side of things. A client paid Sophia $2,000 upfront for 2 months of consulting work. Now, when she first got that cash, it wasn't revenue, not yet. It was a liability, something called unearned revenue, because she owed the client the work. Now it's the end of the first month, and she's done half the job. So what's the adjustment? We debit or decrease that unearned revenue liability by $1,000 because she doesn't owe that part of the work anymore. Then we credit or increase her actual service revenue by $1,000. Now her books accurately show she earned that money this month. All right, now let's flip the script and look at the second category, accruals. This is the mirror image of what we just did. This is when the work gets done or an expense happens, but the cash just hasn't moved yet. A perfect example of this is wages. Let's say Sophia's assistant worked the last week of December and earned $200, but payday isn't until the first week of January. Well, according to that matching principle, that $200 expense belongs in December because that's when the work was done to help generate December's revenue.
To get this right, we debit wages expense for $200 to make sure that cost is counted in December. Then we credit a liability account called wages payable for $200. This is basically an IOU. It shows that Sophia owes the money even though she hasn't paid it yet. A perfect match.
Okay, one last example, this time an accrued revenue. It's December 30th, right at the buzzer, and Sophia finishes a project for a client worth $1,200. She did the work, so she definitely earned the money, but it's so late in the month, she hasn't even had time to send the invoice, so no cash has been recorded.
To make her books accurate, we need one more adjustment. We debit an asset called accounts receivable for $1,200. This shows the client now owes her money. And we credit service revenue for the same amount to recognize that she earned that income in December. Her revenue for the month is now totally up to date.
Now, these same basic ideas of deferrals and accruals apply to all sorts of other situations. Two of the big ones are depreciation, which is just a fancy way of spreading the cost of a big purchase, like a van. Over the years, you'll use it. And bad debts, where you have to estimate that, unfortunately, some customers just aren't going to pay you.
So after all those essential edits for the supplies, the unearned revenue, the wages she owes, the revenue she's earned, we finally get to the payoff. We finally get to see the final accurate picture.
And here it is. This is the adjusted trial balance. If you look closely, you'll see all our accounts have been updated. Her supplies account is now down to $500, not $600. Her service revenue and her wages expense for the month are now correct. And most importantly, look at the bottom line. The total debits still equal the total credits. Everything is perfectly in balance. And these are the numbers we can trust. So, we've walked through the whole process step by step. But let's take a step back and ask the big question. Why does any of this really matter? What's the so what in all this debiting and crediting?
Here's what I really want you to remember. Adjusting entries are not for fixing mistakes somebody made. They're a totally normal, necessary part of the accounting cycle. Their whole purpose is to guarantee timeliness and accuracy. They make sure we perfectly match our revenues to the expenses that helped create them, and in the end, they provide the true, reliable data that we need to build our financial statements.
You see, at the end of the day, your financial statements tell a story about your business, its health, its performance, its potential. And this whole process of making adjustments is what ensures that the story they tell isn't just a messy, rough draft, but the accurate, complete, and true final version. So, let me leave you with this. What story do you want yours to tell?